one of the prevailing narratives is that you can't get a fund returner for $1 billion fund. So we had a look at our data and we found 45 investments that have returned $1 billion to the single fund that invested and were also fund returners. What you need to do is to compare fund sizes today with the exit sizes in 10 to 15 years, because that's when those companies are ultimately going to become liquid.
Dave, I am so excited for this. I've heard many of your conversations before. You have some strong opinions, which I'm excited to dive into. So thank you for joining me.
Yeah, no, it's a pleasure, Harry. I've been listening to your podcast for a long time and really impressed by what you've built here and the guests, and so honored to be part of it.
Do you know it's been 10 years?
Wow.
Like, I'm getting freaking old. But
you must have started when you were 12, did you?
I was actually 14, but I'm glad that it was an early start. You've been an LP for 32 years, and 32 years with Vencap.
Yeah.
How sorry, I didn't mean to age you there, but how did you first become an LP, and when was that I want to do this as a career?
Yeah, funnily enough, I didn't grow up thinking actually my life's ambition is to become an LP in VC funds. I grew up in a small village in Northumberland. I'm pretty sure that nobody in that village had ever heard of venture capital, and I hadn't heard of venture capital. But I sort of finished university. I actually was keen to kind of go on and do a PhD, but kind of life intervened at that time, and I had to end up getting some real work. And I was just looking for pretty much anything. I saw an advert. So my girlfriend at the time, my wife now, was living in Oxford. I was still living with my parents up in Northumberland. And so when I came down to see her, I was looking for a job. I saw an advert in the Oxford Times, numerate graduates required for global finance firm. And I thought, well, it doesn't sound very interesting, but if I don't apply for it, she's going to see it and she'll kill me. So that was 1992, and I was fortunate enough that my first boss was willing to take a punt on a spotty fresh graduate with no experience who'd never heard of VC before.
I absolutely love that. I mean, often fear is a great driver. When did you know that you actually loved doing it?
Like, for me, I'm curious about things, and I like to sort of really dig into the detail, and it was probably after sort of 4 or 5 years when we were starting to see the first kind of .com companies begin to emerge. I remember we got a stock distribution of Netscape. And it was my job to figure out what we were going to do with stock distributions. So I remember phoning up the CFO of Netscape at the time as a 6-month public company and having a conversation with them and thinking, shit, this is really interesting. I never thought that I'd be doing something like this, but actually having that kind of not quite a front row seat as an LP, but maybe a second row seat into new technology, new developments that are changing society. I struggle to think of a more interesting career in a more interesting way to have spent the last 30 years.
I mean, it is an incredibly interesting seat to have. It's also a seat that's changed over time, I'm sure.
Yeah.
Ryan Akina at MIT said that it's become harder than ever. I'm intrigued. Do you think it has become harder than ever?
I can see why you would have that perspective in the sense that there are just so many funds and managers out there today, and you are constantly bombarded by people who are trying to raise money and want to pitch you, and it's simply impossible if you were trying to meet with everyone to be able to work through those and to select successfully. And so I think from an LP, one of the things we've learned is that being an LP is all about understanding what you're good at and understanding what you're not good at and making sure that you are focused. So for us, actually, the last 5 or 6 years have been very simple, because our view is that it's been impossible to actually distinguish good managers from average managers, because everyone looked good. Everyone had companies that were getting written up. Everyone could talk about some interesting deals that they'd done. Everything looked great. But I think one of the advantages of having been in this industry for so long is that we've seen cycles happen before. And we've made all the mistakes in the book. I remember in the early 90s, in the late 90s rather, we massively expanded our roster of managers. We did a lot of first-time funds, and this was all in 98, 99, when things were looking unbelievable. We were backing managers in a fund 2 where their first fund was showing 100% IRR and a 5x TVPI, a couple of years later, those funds were looking very different. And so I think it's really sort of understanding what it is that you want to see in a manager. That's what you have to do in order to be able to do this job successfully and be ruthless about sticking to that particular focus.
My question to you though then is, if you think about the last 5 or 6 years, it's impossible to select, everyone looks good, then you end up doing nothing. And you have to stay at the forefront of great managers. You have to ensure that you don't miss the next great franchise. How do you approach that, knowing that you don't want to enter a world where you can't decide, but also you can't miss?
Yeah, I think you can miss, because again, one of the things that we've learned is that you don't have to do every great manager out there. You just have to make sure all the managers you do are great. So it's not about trying to see everything and pick everything that has the potential to rise into that top quartile or top decile. It's about understanding what your lane is, being comfortable in your lane, and recognizing that lane is still relevant and is still able to produce the performance that you expect from the asset class. And I think particularly over the last 5 years, we just felt it was, even if we saw a really good manager, we thought it was the wrong time to intercept them. And actually, there would be a much better opportunity when there was far less noise and far more signal to fine-tune that decision. And we saw this back in 2010, 2011, 2012, where we were able to add several top-tier managers after the financial crisis, because a lot of their traditional LPs were struggling with the denominator effect. There'd been very little liquidity, so they were struggling to make new commitments. And I think a lot of those managers there recognized it was important to have a reasonably diversified LP base. So not just Ivy League endowments, but also some family offices, some fund of funds. And as you know, as a fund of fund, we don't suffer from the denominator effect because we raise capital and then we invest it. So as long as we've managed to have our close before the market turns, we've got capital that we can invest into a much better environment.
Far less noise and far more signal sounds wonderful. Sadly, when you have far more signal, there's far more noise. And traditionally, I agree with you in terms of supply of capital in cycles, but there is a permanence to the wall of capital that has entered venture, I think. And you're seeing a new size of that with sovereigns and pensions doing what they're doing today. Is that possible anymore?
I think, again, it comes down to understanding how venture works and going back to the first principles of the industry. And that's one of the things that we've always tried to do, is to really go deep on understanding what is it that makes a great fund, what is it that really drives outperformance in the venture industry. And the thing that we constantly come back to is that venture is a power law industry, and it's 1% of the exits that ultimately generate the bulk of the returns created by the entire industry globally. So we're looking at around 30 companies a year that generate more than half of the total exit value for the VC industry. And when we look at who are the investors in those companies, it tends to be the same names time and time and time again. And so for us, we'd much rather spend our time trying to access those very best names than trying to find that needle in a haystack, that one in a 500 new emerging managers that might potentially do that. And if it means we miss out on one of those managers, then we're fine with that, because we've got enough in our roster that continue to find those key companies and drive that outperformance.
You're right, absolutely, that there are a continuing set of names that are in the best. Those continuing set of names are also most often in the multi-billions of dollars in terms of AUM and fund size, and that will dramatically impede their level of having a 5x net fund, say. It is just fucking hard to do a 5x net on the size capital they have.
It's hard to do a 5x net full stop. So we had a look at the PitchBook data around DPI. So we looked at funds from 2000, and again, this is going back to first principles here. Rather than looking at research that other people have done, we want to go back to the original data ourselves and figure out what's going on here. So there was about 1,200 funds that were raised from 2000 to 2014, 15, I forget the exact date. And we looked at what the DPI statistics were for those funds. More than 50% hadn't returned 1x capital. And so these are funds that are 10 years old now, at least 10 years old now, hadn't returned 1x capital. There was just 6.6% that had generated 3x net DPI, and just 2.6% that had generated 5x DPI. So when you're talking about the incidence of 5x funds, let's put that into context that it's 1 in 50 funds that's capable of generating a 5x fund, according to the data on PitchBook.
Which begs a couple of different questions. Begs the question, is venture really worth the illiquidity premium? You are a fund of funds, but the S&P will get you 2.6 over 10 years, pretty much with guarantees and with liquidity. Why bother doing venture?
Because it's a power low industry. And if you're able to consistently compound at that top quartile in venture, then you're going to massively outperform the NASDAQ, massively outperform the S&P.
But if the fund sizes are so large, we're seeing, I do name names, but I'm not saying anything about their performance, but your Andreessens, your GCs, your Lightspeeds, your any of the big firm brand names, they're multi-billions of dollars. Doing a 3x is insanely hard, again, on a lot of fund size, but on that it's so hard.
And I think for us that's the one big thing that keeps us awake at night. It's have these funds become so big that they can't ultimately deliver that type of performance. And today we haven't seen that. So there's a few.
When you say that type of performance, what is the type of performance you need?
North of 3x.
North of 3x.
On an aggregate portfolio level. So when I look at, and we've disclosed a little bit of the sort of high level performance, so happy to do that. So we have a group of a dozen core managers, and like 90% of all the capital we've invested over the last decade plus has gone to those managers. And when we look at the performance of their mature funds, so let's take away the ones that were raised in the last couple of years, we are seeing a net multiple back to us north of 3x, around that kind of 3.5x on a blended basis, on an aggregate basis. So this isn't pie in the sky numbers. This is what those funds have delivered. And the other thing to look at there is what percentage of them have actually lost money. So go back to that 50% of funds from PitchBook haven't returned 1x DPI. What we found is less than 3% of those funds are showing a TVPI of less than 1x.
Wow.
And this is going back, some of those funds are going back 30 years. So that's through the dot-com boom and bust. It's through the financial crisis. So what we're able to do still is to capture a significant chunk of that upside while minimizing the risk of losing capital. But I don't want to not answer your question on fund size, because I think this is really important. And again, one of the prevailing narratives is that you can't get a fund returner for $1 billion fund. So we had a look at our data, and we found 45 investments that have returned $1 billion to the single fund that invested, and were also fund returners. And most of those have happened in the last 7 or 8 years. So the idea that you can't get a fund returner from $1 billion fund is just untrue. And actually the majority of those weren't just $1 billion, they were multiples of that. I think the most we have is a $15 billion outcome for a single fund. So you have to sort of understand the size of the outcomes that we're now talking about for these funds. And just one last point, Harry. The other thing that I think you also have to bear in mind is that you're comparing today's fund sizes with today's exit sizes. If I look back 15 years ago, I was having exactly the same conversations about funds. They're way too large. You're never going to get a 3x multiple. What you need to do is to compare fund sizes today with the exit sizes in 10 to 15 years, because that's when those companies are ultimately going to become liquid. And if you look at how those exit sizes have increased over the last 15 years, are you saying to me that you don't think technology outcomes are going to get bigger over the next 15 years?
So then let's play this game out then. I like that a lot, because most people are like, well, we need to compare fund sizes today to exit sizes today. And actually, we've had this realization that we were wrong in COVID and that companies shouldn't be 40x revenues, they should be. And we're back to the normal now. And so it's really interesting to say, hey, project yourself forward 10 years to the exit size of 10 years' time. What do you think the exit size of 10 years' time is then?
Yeah, I think, so in the famous words of Yogi Berra, predictions are hard, especially those about the future. So I think what you have to look at, we would sort of take a step back and say, is technology becoming more or less important? Is it capturing a smaller or larger share of the economic pie? And are the market sizes for the winners in technology getting smaller or bigger? We think all of those arrows are pointing upwards. And so, yes, we know the multiples that you will see on those individual companies' earnings or revenues are going to fluctuate. But ultimately, the markets that they're playing in and the share of the economic pie that technology is going to capture, in our view, is only going to increase. And so that gives us confidence that whatever the multiples are at the time of exit, directionally, we're going to see exits get larger.
Do you worry that we've never had such a strong incumbent set? People often say, oh, we've always had incumbents and they've always been usurped by innovation. We've never had data network effects like we do today. We've never had, Microsoft doing whatever it is, 300 million in free cash flow.
We've never had a Lina Khan either.
No. And so, very good point. And so I worry intensely that, yes, the market size increases, the proportion of spend to tech increase, but it concentrates intensely, which is not good for us.
Yep.
Do you share my worry on that?
I think you're right. Yeah, that was I think it's clear that the incumbents today have managed to have multiple iterations of their products, and the question I would have though is how long is that likely to continue? And I remember back in the mid-90s reading The Innovator's Dilemma, Clayton Christensen, and it was a real eye-opener at the time, just around how it's very difficult for those incumbents to really innovate and to disrupt their own business and cannibalize their own business models. And it's interesting, look at what's happening with someone like Google today. Look at the reaction to their AI product that we've just seen over the last couple of weeks, and all those people that are now saying, Google needs to really address where they're going as a business. Look at what Elon's done with Twitter in terms of turning that company on its head. I think there are a lot of challenges for the incumbents, and there's no guarantees that they're going to be able to continue to hold that dominant position, particularly as we enter different technology paradigms. So one of the things, I don't know if you've had a chance to read Chris Dixon's book yet.
No, I haven't, but I've got him coming on the show in a week.
Oh, fantastic.
So I probably should do. But yes.
But I think what's really interesting there is I study philosophy at university, and one of the things we looked at, there was a really small book called the Structure of Scientific Revolutions by a guy called Thomas Kuhn, and it's really interesting about the way that science works in paradigms, and by a paradigm, it basically means a particular way of thinking. And that paradigm exists for a certain amount of time. And then new evidence, new data emerges, and the paradigm changes. And when the paradigm changes, it's hugely disruptive. And I see similar things happening in technology. We've seen it with the mainframe. We've seen it with client server. We've seen it with the first generation of the internet. We've seen it with mobile. We're seeing it now with AI. And the one thing I would put on top of that is blockchain and crypto. And if we do see blockchain and crypto really emerge as a dominant technology paradigm in conjunction with AI, then I think that's going to have a very significant impact on the incumbents that are out there.
Do you not think, though, that actually the thing that actually made the prior incumbents usurpable or replaceable, in whatever way we want to call it, is actually the lack of linkage between them and the new platform? And I think what concerns me most is when you look at, the platform shift that we see today with AI, fundamentally it also all goes down to compute as well. Ability to spend on compute, scale of buy, scale of purchase, scale of data, scale of data quality. There is a core linkage in the prior platform to this platform, which gives them unparalleled advantages that we didn't have when moving from on-prem to cloud.
Yeah. But I also look at, so if we were then saying, what's the likelihood that we're going to see another kind of outcome in that sort of multi-$100 billion region. You look at something like a ByteDance in China, which has emerged over the last 10 years. While a lot of these companies were there, now it's admittedly a different market and more restricted, and those companies haven't been able to operate to the same extent in China. You look at how OpenAI has really begun to win that category. Now, still very early, and who knows ultimately what's going to happen there. But I still feel optimistic that it's the fundamental nature of technology is that incumbents ultimately have a half-life, and that half-life has admittedly got longer. But I do think we will still see companies come over time that will disrupt those industries, and it will be based on different technology paradigms.
So I'm interested, you said about kind of the amount of funds that were able to return $1 billion and even one that did $15 billion. Liquidity in venture is one of the most important things. I think it's Horsley Bridge data, where they talk about the compressed timelines for liquidity and how, unless you take advantage of them, venture's a really shit asset class. But if you do take advantage of them, then it's brilliant.
Yeah.
My question to you is, how do you think about liquidity strategies in those very short timelines and the managers that do it well and those that don't? Because otherwise it is shit.
Yeah, no, and I think I would absolutely agree with that. It's the classic thing where there's years where very little happen, and then there's weeks where years happen, sort of thing. And so, you do see that in venture. There are short periods of time where you need to capture the value. And if you don't do that, then you're going to struggle. So I think, again, it comes back to, for us, investing in managers who really understand the dynamics of the industry, who've been through those cycles before, or have people within their firm that have been through those cycles before, and understand the importance of generating liquidity when it's available. And from an LP's perspective, the way that you're able to do that is to make sure that you are investing consistently across every vintage. You're not trying to time the market, because if I look at the stuff that we were seeing get liquid in 2019, 2020, 21, these are the investments that we made 10 years earlier.
Yeah.
And 10 years earlier was 2010, 2011. This was financial crisis when people weren't deploying checks.
I write this stupid schedule and I just don't listen to it at all because it's way more interesting. Liquidity is predicated on often IPOs or M&A. You mentioned Lena Khan. M&A is pretty much fucked. I'm worried about that. Do you share my concern?
Yeah, in the short term, I do. Yeah, I think it's interesting how the UK regulator can block two US companies from merging, which is an interesting one with Figma and Adobe. And so I think it's going to be a challenge for the big tech companies to acquire significant new product. And that goes back to the conversation we were having a second ago about their ability to iterate and continue to stay in that position. But I do think it makes it harder for the M&A market to operate at scale. And so I think for companies, it's becoming increasingly important that they view themselves as standalone businesses, and for the founders to take the view that this is not just a kind of, let's get it to a couple of $1 million in revenue and then we can sell it to someone. It's about how do we build something that's actually durable and sustainable and standalone. And those are the sort of companies that ultimately are able to go public. I think the impact that will have is that the concentration of returns in venture is going to be even smaller, as in there are going to be fewer companies that ultimately account for that performance. And so it's going to be even more important that you're backing managers that can identify them, win them, work them, and as you said earlier, know when to get out.
I totally agree with you and get you there. You said about the UK blocking two American companies from merging. I had Larry Summers on the show and he very much stated that, I can't remember, China's a jail, Japan's a whatever it is, an old people's home, and Europe's a museum.
Yeah.
Keith Raboy was has a go at me for being here. How do you feel about Europe? Do you share the world's concern around Europe falling drastically behind an ever-increasing China and US?
I think, I'm not a macro economist, so I know my area.
Well, neither is any venture investor, but we still opine.
Yeah, but I'm as an LP, I kind of know my lane and happy to sort of stick in that. If I'm looking at it from a venture perspective, I think it's important as an LP to know what you know and know what you don't know. So I'll tell you what I don't know. I don't know what the next great sector is going to be. I don't know where the next great company is going to come from. I don't know whether Europe is going to outperform China or India or the US. What I have a much better sense of are who are the people who do know that or have a good shot at knowing that. And this comes back to, as an LP, my job is to select managers. And I want to select those managers who can consistently find those top 1% companies, wherever they are, geographically or wherever they are in terms of industry, sector, whatever. So I think that's really important. And when I look at our portfolio, there's a reason only 10% of our portfolio is invested in Europe.
How much is in the US?
70.
China?
10.
Is China going to nothing?
Not sure.
Yeah.
It's come down by half over the last 10 years.
Yeah.
So
This is a really interesting thing that, obviously I speak to a lot of LPs, and, there's been dramatic shifts in allocation towards obviously China and Israel over the last, few years, towards the US and Europe again. Like, there's been an influx of additional capital that's come from that.
And I think that's, and we've seen that. I was just chatting to a guy I know at a UK fund earlier today, and they've just recently closed and done a fantastic job and had actually raised a lot of capital from US investors, and he was thinking a lot of that is possibly those investors taking their China allocation and now moving it into Europe.
I think we would fall in that bucket. I have one European investor and everyone else is US.
Yeah. Our perspective is we don't want to, I don't care how much is in Europe. I don't care how much is in the US. What I care about is, are we getting exposure to
the best managers?
The best, those top 1% companies, and that will define the best managers. And so when I look back at the best VC exits over the last 6 or 7 years, the managers that we've backed have been in 85% of the top 20 or 30 exits there. So we're consistently getting exposure, and not just logo exposure, like proper exposure.
When did you do your last fund?
What do you mean? When did we last make an
When
investment?
did you last make a new investment, a net new fund?
A net, so this is not a re-up.
Not a re-up.
Our last one was probably 2018. And it was a fund 18. I'm not, I prefer not to disclose.
No. You don't have to. You don't have to at all. I would just want to. But so then, I mean this in the nicest way. Is your job not just to not piss off your existing managers? I'm like, Alfie's a friend of mine. I would never bother pitching Alfie because it's like 2008 is 6 years ago.
Yeah.
I'm so sorry to be so rude.
No.
Do your LPs not ask, like, why are we paying fees? Net new investment was 6 years ago.
Yeah.
It's a game of access.
So, ultimately what do our investors care about? Our investors ultimately want to try and get the best risk-adjusted returns they can from the venture industry.
Mm-hmm.
And we think we have a strategy that delivers that. In a way, trying to sort of understand how that strategy works under the hood. It's a bit like how do our managers find their best companies? I don't really care how they do it. There's lots of different ways to be a successful VC investor. I'm less worried about that. I'm more worried about their output than their process. From our perspective, we want to continue to deliver that performance. And so we are paranoid about every time I was just doing something today, there was a new white paper about why emerging managers and small funds outperform. And I'm all over that data, because I want to understand, what are we missing? What's wrong with our strategy? Why should we do a whole load of net new managers? What advantage will it give us? And
I'm so intrigued. You said there about output. I'm loving this, but you said there about output over process. I just think that's so wrong, because like the investment decision-making process is the product of venture capital. And actually, when you think about sustaining great returns, and when you think about what makes a firm great, it's the process it's the inputs that lead to the outputs. I could have a random investment in Uber from a friend who I've worked with before, crap process, crap portfolio. My output will be great. Yeah. That fund will be great.
How do you know if the process works?
You do a review.
Of the process or of the output?
You can do a review of both.
How do you know? How can you know the process works unless you judge it by the output?
In terms of like, how do we know? Because it's such a long timeline for knowing.
Yeah, how do you know that somebody's investment process is better than somebody else's investment process?
I think you can understand the quality of one's thinking and how they think about creating environments of safety where you actually champion and challenge together, where you hear all voices, when there isn't a dominant voice, when there isn't a bias, a bully, when there isn't uneven confidences in a partnership, when there isn't unequal distribution on personality.
So you wouldn't invest in Vinod Khosla?
I mean, that is...
You wouldn't invest in Brian Singerman? where there's a single, where Founders Fund have a single, single GPs can go and do deals. Andreessen Horowitz.
I definitely do that, but they challenge each other intensely. Brian will get pushback from Peter like nothing else, and he'll get pushback from Napoleon, and he'll get pushback from all of his other partners. He will be rigorously challenged. No, I wouldn't do a partnership where I felt one, Khosla. Yes, I would. Why? Because I think Keith would push back immensely if he didn't like a deal that Vinod liked, and I think Vinod would listen.
Yeah, I'm not saying I think one of the things that
I get you totally.
One of the things that I've seen is that there's no single right way to do venture. There's no single right way to make decisions. There's no single right way to structure a partnership. There's no single right background for a successful VC, and actually trying to predict what the key determinants of success are. We've tried to do it and we haven't been able to do it. And I would love to see the long-term data from other LPs that says that they have been able to do it. And it may just be us. It may be that, we're in Oxford, we're not in Silicon Valley. If you're in a different environment, you can do things differently. You see things differently. You have a very different inputs. But I think one of the things that we feel very strongly is that actually all the talk about edge and how you pick emerging managers, how do you know if you're successful or not with your strategy? And it's very easy to talk about, I found this fund, or I've done that, or I look for this. How do you go back in 10 to 15 years' time and say, did that actually work or did it not? And what we've been able to do with our strategy is to look back, because we've been doing it for so long, we've been able to look back at the output and go, that's actually been successful.
Do you not worry that is a lagging indicator? It doesn't represent a new strategy. I hear a lot of endowment funds today that say, oh, we've got the Yale David Swenson model. And I'm like, he did that in the 80s when there were much fewer managers to select and venture had much better returns. That is not a comparable strategy today. Do you not worry that is lagging data that you are now acting on in today's environment?
Yeah, and I think totally accept that one of the challenges of venture is that the feedback loop is so long. And to be honest, most LPs probably aren't going to be in the same job when that feedback comes. So they're more worried about deploying than they are about what happens 15 years down the line when the performance data is actually in. But then I would kind of flip that around and say, let's go back to the first principles. So I totally accept that. Let's go back to the first principles. Let's go back to the underlying performance data, and let's see what strategies can be successful. And for us, it's we think venture is such a power law industry.
There are new strategies which haven't been done before. To the extent that they have, like Sam Altman, who is obviously a fantastic CEO and also invests heavily on the side. There haven't been cases like him before. And so we don't have data sets to predict forward on or to judge against. How do we think about entirely new models, which may be better?
Yeah, and I think as an investor, it's a little bit, for us, we don't feel we need to be out there trying to test these new theories. What we need to try and do is to find when something is working, to jump on it as quickly as we can, and then trying to get access in there where we have more signal and more conviction that it's not just a good story, a good narrative, but actually it's going to result in strong performance. And so when we do look, we are looking at adding new managers in the market today, because we think that signal to noise ratio looks a lot better, because we're now starting to see a lot of those companies that raised money in the height of the ZERP era, begin to come back down to ground and get a sense of what they're really worth. And so I do think over the next couple of years you will start to see managers differentiate themselves. But I think for us, the earliest we would intercept a manager would probably be Fund 3. And that's where we've had the most success historically. So if I look at our 12 managers, probably half of them we ended up doing at Fund 3.
Why is that the critical juncture?
I think it's because you get a better sense in Fund 1 as to whether or not they've been able to find one of those top 1% companies. And once you have found one of those top 1% companies, again, our experience and our data suggests that you're more likely to be able to replicate that. So again, going back to some of the academic data that's out there, it does suggest that that first success is actually random. But once you've had that first success, there's a higher likelihood that you can then leverage it and start that virtuous circle and begin to build a franchise.
Do you care about the ownership on that first success?
It has to be material. Yeah, it has to. It's not just the ownership. It's also the role of the investor in contributing towards that success. So if you wrote a $50,000 seed check and turned up 15 years later and found you had a company that went public at a $10 billion valuation, then that's less interesting for us. If you were leading around, if you were on the board, if you were working with the entrepreneur very closely, if you were adding value.
Do you think VCs add value?
I think some VCs add value. I think some VCs don't destroy value. I think there's a wide range.
Do you care if your VCs add value? I know it sounds strange, but isn't...
I think we care if we want our VCs to understand when they need to get involved and when they need to get out of the way. Because there will be certain points in a company's life where they do need help. No success happens in a straight line. There are, you look at most of the companies out there that have been successful. At some stage, they had a near-death experience. And I think the role of a founder it can be at times incredibly lonely. So I think there are times when a VC needs to be there for that founder, and needs to give them have a hard conversation with them, and needs to deliver a bit of tough love, but also needs to be supportive, and also in a way to be a psychological support for that founder. So I think the best VCs are able to do that and can pick and choose their times. I think there are clearly VCs out there who just need to back off a whole heap.
I agree with you. I'm just intrigued. So on this juncture of we tend to often find that our entry point is the third fund. And you acknowledge you can't really judge a process, or it's very difficult to judge a process because of the lack of tighter outcomes or the kind of far dated outcome that comes. What else is part of the selection process then? Just help me understand how you get excited by a manager.
Yeah, so I want to say we've never invested in a manager that has come into us directly. So I'll reply to all of them, but it'll be... it's not something we want to spend our time looking at. So we have a pretty simple screen. We want to look at what we think are those top 1% companies. We spend a lot of time looking at who are the early stage investors in them. And then it's a case of us trying to reach out and build relationships with those managers. So our deal flow is all outbound.
Deal flow is all outbound?
Yeah.
Wow. Okay, how much is referrals from other managers that you're in?
If they're not on our list, none.
Huh. So then, just help me understand, what will lead you to outbound a manager? Is it oh, I really like their portfolio? Oh, that's an incredible background? Oh, I've seen their returns in pitch book?
It's looking at those top 1% companies.
Yeah.
So we have a list of all the top 1% companies that we think that that are out there, the ones that have exited, the ones that are just below, and we're looking at who are the investors in those, who are the early stage investors, and we start to see names that we don't recognize. That's when we'll get interested and we'll do a little bit of work to see is this where did they intercept these companies. Maybe that's when we'll do some soft referencing amongst our GPs and say, what do you think of such and such? If they're not in that screen, then we're not going to spend our time there. And this goes back to the conversation we had right at the start about, is it harder to be an LP today? Yes and no, depending on how you're looking at the industry and how you're screening the potential candidates for investment.
Okay, but we find one and we are yes, that's great. We really want to invest. We want to do the 2018 net new investment. If they're smashing it out of the park and in the top 1% of companies, they don't have any allocation in their funds. Everyone is taking up the allocation. How do you, and respectfully, you're a fund of funds, so you're not a foundation, you're not a healthcare institution.
Yeah.
How on earth do you win?
Persistence. It's understanding the entry point as well. Even great firms go through challenging periods of time. One of the reasons why we see great firms fail is because they don't handle succession well. And some of them will handle succession badly, but get there eventually. So there may be an opportunity to intercept during the period where people are thinking, is this still a manager that makes sense? We talked about intercepting a number of our existing managers post-financial crisis. I think there's an opportunity today. We know the lack of liquidity is having an impact on a number of LPs because they need to have distributions coming back in order to make new commitments. So I do think there's an opportunity to potentially.
Are you seeing that though? Actually, because the last few years actually weren't bad. If you were a good LP, the last few years weren't bad for distributions. Plus, the denominator effect is better now, given where public markets are. Like, is it really the problem that we thought it was?
I think the denominator effect, you're right, has dissipated. I look at the distributions that we're getting, and we had a good 2023, but that was on the back of things that went public in 2021. And one of the metrics we track is what's the value of the public stock that's held by our managers. And that number has been coming down, and there have been no net new adds to that list for the last 18 months or so.
And they don't distribute to you, they hold for you?
They will distribute over time. So it probably takes 18 months, 24 months for a position to be fully realized from those managers. So, we're getting to the stage now where those companies that went public in the sort of second half of 21, they've certainly distributed the bulk of the shares that they had. There is some still left. So, we are seeing liquidity still coming back, but it will take time to replenish that inventory. So even if we start to see IPOs in the second half of this year, it's going to be 6 months before those shares become freely tradable. And again, it will probably be another 12 to 18 months before those positions ultimately get fully distributed.
Hard question. Those positions are fully distributed. Do you hold or do you sell?
We tend to sell because we don't think it's our job to hold public stock for our investors. They have their equity managers who do that and would do a better job than we would. Now, we don't necessarily go back to the VCs and say to them, you should distribute as soon as the stock comes freely tradable. We want them to use their judgment as to when to distribute stock, particularly if they're still closely involved with that company. Because we've seen a number of occasions where the very best companies will continue to compound as a public company, and actually holding for a period of time after that is actually beneficial for performance.
I was speaking to a dear friend who's an LP, and they said, listen, the managers who I will chastise are those who had the chance to distribute in the last few years and did not. Then I will get angry. Do you share that perspective?
It depends on why they didn't distribute, and I don't think you can take it on a case by case, like company by company basis. I think you have to look at the overall volume of their work. So if they've decided to hold, let's say they had 10 companies that went public and they decided to hold one of them and they distributed the rest, and they decided to hold that one because there were very specific reasons why they felt there was significant upside there, then we have no problem with that. But it should be the exception rather than the norm. And I think it's interesting that the criticism that Sequoia had for the Sequoia fund, it's absolutely the right idea. It just happened that they implemented it at a time in the market where you saw a significant correction once it was put in place. I
don't disagree with you, but for those that maybe aren't aware, can you just explain your thesis why you think it is the right idea? Because many question that at all.
Yeah. I think, again, our experience has been, when we talk about venture, there's a power law, but that is even true when you look at public companies that come from the venture industry. So there are a handful of public companies that have continued to compound at high levels for multiple years after going public. And in a way, the IPO, I don't necessarily view it as a systematically, it's not a systematically different company post-IPO than pre-IPO. Yes, there's reporting differences and they've got to manage, to quarterly expectations to some extent. But I think the very best companies can continue on that journey. And it seems if you're in one of those top 1% companies, like ride it all the way. Don't try and sell it early because you need to get points on the board. And again, this comes back to, what do our managers do really well and what differentiates the very best managers from the rest of the pack. It's they recognize when they do have one of those top 1% companies and they have the confidence and they've got the history to know that if they do hold on to it and things go wrong, it's not going to be fatal for them. But they trust their judgment that actually by doing that, they can see.
Do you think you can really tell? And I use NVIDIA as a good example here. Like NVIDIA was public for a very long time before the last few years. The acceleration in enterprise value of that company is unbelievable and exceptional. But bluntly, I remember recommending it to my godfather in 2012 because I saw the rise in usage of mobile gaming and they compute behind that.
Yeah.
I had no fucking idea about AI in 2012 and they're being at the forefront of that. And I don't think many of the venture investors would have sold when they went public, whenever that was. And so do you think you can even tell, honestly?
I think it depends on where you are in that company's life cycle. So at the time NVIDIA went public, it was a very different business. And I don't think you could have predicted the AI wave.
Yeah.
But I look at what happened with Square, for example. So Square went public. It was a couple of $1 billion company. I know 2 of the venture investors in there held on to that for several years post-IPO because they knew the Cash App was coming. They knew there was another leg there. And they felt that the market wasn't fully valuing the option value of that second product line. And so where you have that sort of situation, then I think it's absolutely right for the venture investors to continue holding.
I agree with you and I get you. Can I ask, you said about kind of succession, and I am really intrigued on that because you said, you like to have that juncture where maybe there's a faltering, but different firms make it through, different firms don't make it through. What have been some of your biggest lessons from 32 years?
You don't have to keep rubbing it in.
I know, I'm so impressed. What are your biggest lessons in those that make it through tough succession and those that don't? Because there's many that don't that we kind of forget about.
I think, when we look at the firms that have done it well, I think they recognize it's important and they don't wait too long to address it. So there's one of the managers that we back that has a policy that says once you get to a certain age, you're out unless you're invited by the rest of the partners to stay within the partnership.
Explicitly ageist, I like.
I think what that does, it really sets the precedent that this is a partnership, it's a firm, and the firm is more important than any individual. And I think that's really important. And where we've seen firms not handle it well, it's where the senior partners and maybe the founding partners have just been there for too long. They've kept too much of the economics. They haven't cleared a path for the people below them to come and really step up. And I think, things change so quickly in venture that you've got to have that continued fresh blood coming through. Otherwise, you get stale really quickly.
Do you think you're close enough to know when things change in the firms that you're in? Like, I don't know the firms you're in and respect that, but I'm sure I could tell you some horror stories right now of firms, things that are happening in your firms because my friends are in them. And it's like founders know founders.
Yeah.
Do you know what I mean?
Yeah.
Do you think you're close enough to know?
It's probably a fund later than the issues would start to emerge. Mm-hmm. But at the same time, I think you probably hear a lot of just general scuttlebutt about what's going on in there and how much of that actually plays out. So I think you can almost hear too much and not understand or find it a challenge to really appreciate what's material for the firm, and everyone likes to moan about where they work. That's never changed. I think for us what we tend to look for is to make sure that firms have that process where we're seeing a continual flow of new people coming in and they're being valued for the work that they're doing and the senior partners stepping aside. Now,
how do you know the work that they're doing is good?
Well, I think again it comes down to ventures. Unfortunately, there's a lagging indicator there. So I think it's trying to sort of understand who are the value drivers within a portfolio. Who are those top potential 1% companies, and then understanding who actually sourced those deals, who did the work. Are they the ones that are being elevated within the partnership? And is there enough room at the top end to let them have the freedom to come in and continue to do those deals and ultimately start to influence the behavior of that partnership and the strategic direction?
Who do you think's done generational transition the best?
I think there's two interesting ways of doing it. So if I look at the firms that are on, I look at someone like Axel, who is probably on the third or fourth generation now of leaders within that firm. I think they'd probably admit that they didn't get everything perfect, but I think they've handled most of those transitions pretty well, and it's really hard. I think Sequoia have a really interesting way of doing it as well, where people kind of step aside and Don Valentine stepped aside for Mike and Doug. Doug stepped aside for Roloff. So I think they understand the importance of doing that. The other way is I think Foundry Group have done a really good job.
I love Foundry Group
because they've understood that actually we're not going to try and do that. There's a group of people here that want to work together, and when we're done, we're done. And that I really respect that they haven't tried to pretend.
Do you know Foundry Group? I cold emailed Brad Feld when I was 18, and he would get on a call with me. He would help me. He would mentor me. I think it's astonishing, this industry, for the amount that actually the best do give back, which is really special.
Yeah.
Can you talk to me about your re-up process? I'm being serious. Is it just like, yep?
So I think we have a pretty good sense of who, like, if you asked me today, I could tell you who we would re-up with and who are the ones where there's more of a decision. I think 90% of the managers that we have, we're very happy with. We know we're going to re-up with them. And in a way, our diligence on them is a continuous process. It's not about they're now raising a fund, let's kind of meet them and talk to them for the first time. We want to continue to, we spend time with our managers as much as we can without getting in their way. But we also, make sure that we're doing a lot of work behind the scenes to understand the quality of their portfolio. Mm-hmm. Do they continue to have those key companies? Are they in their more recent funds? But having said that, for every investment we do, we still go through a full diligence process. So we will write we'll take references, we'll write our full investment recommendation. But
you've got to give Alfie something to do. Seriously.
But I think that's more confirmatory diligence, that like have we missed something here? And so it's not a case of do we think there's something we're worried about here? It's really a case of making sure that there's not something that's fallen through the cracks that we haven't missed. And also, to be perfectly honest, if something goes wrong in the future, we want to be able to point to our LPs and say, look, we've actually done a thorough job here. We're not just sitting there and on the beach smoking cigars and not doing not doing the work. We are properly looking after the money that we've been entrusted with. And making sure that that every decision we make has got a rigorous process behind it.
And I totally get that. Do you always do 3 funds?
No.
No.
Do
you always do 2 funds?
No.
That's why would you not do the second?
So there's been an instance of a manager where we've only done 1 fund, and there were very specific reasons for that. It was mainly a China fund, and there were some team issues. So,
is team the number one reason you won't do a fund? Ironically, I think the best funds break down because of partnerships breaking down.
I think that the 2 reasons we don't do, the 2 reasons we would say no to an existing manager would be performance and succession. So the succession in a way is team.
Yeah. Okay. Yeah. Okay. So I'm intrigued. If a manager is surprised that you're not coming back, is that your fault?
Yes.
Like, do you get ahead of it?
Yes.
How far ahead of it?
So one of the things we do with a lot of our managers is we send them our internal benchmarks. So we will compare, all of their funds to all of the other and this is great because Cambridge or PitchBook or Preqin compare, they show the market, but our managers want to really understand how do we compare with our peers. So one of the things we do is every quarter, every 6 months, we'll send them the benchmarks that obviously all anonymized, but we'll show where their fund ranks. And because it's a relatively small number of managers, we group it by 3 years. So if you're a 2015 fund, we compare you to funds that we did in 14, 15 and 16. So there's a decent sample size there. And by doing that, I think it allows us to it shows them, it's obvious if they're not performing. And it also shows them where, specific. So we do it by IRR, we do it by TVPI, and we do it by DPI. And so we've had some conversations with people where we've said, look, you guys are really good on IRR and TVPI, but you're lagging on DPI. How are you thinking about that? And some of them will go, look, we think we've got a couple of really good companies here. We're not selling them. We don't want to force liquidity. We want to ride them as long as we can. Then that's great. In others, it would be, okay, that's interesting to know. We think there's probably some of our B companies that we can generate liquidity events for in the near term to help address that.
So it's always hard when you say no to a manager that you invested in or not re-upping, and you send them data and say, listen, this is where you stack rank, and this is what led to our decision. Because you can always have an answer back to that. Well, I'm holding some amazing positions that aren't DPI quite yet, but they will be. Or, well, actually, whatever this may be, there's a ton of variance. Is it not better to just say, I'm so sorry, Dave, we won't be investing? Because it will always inspire a conversation. I could argue 1,000 ways on the data.
Yeah.
But actually, look at them. That's lagging. Look at that shit firm ahead of me. They're all fucking on the beach.
I think we want to be honest with our managers, but there's also limits to how far that honesty is going to go, because we want to give them an explanation as to why, and it's up to them if they want to accept that explanation or if they want to push back on it, and we'll have a conversation, but ultimately it's unlikely to change our mind. I think most of them where we have had that conversation have accepted it and moved on.
What are you sensitive? How do you feel about compression of deployment timelines?
So one of the lessons, I said we've made all the mistakes in the book. One of the mistakes we made in the late 90s was deploying our funds too quickly. I think we had one fund that was fully invested in 15 months, and it was the worst fund we had. So it was in a 1999 vintage fund. So as you can imagine, not the best outcomes there. And I think one of the lessons we learned there was that time diversification in a fund is so important, and so we look to invest all of our funds across a 3-year period. And one of the things I'm really proud of was that when I look at the fund that was deploying 19, 20, 21, we did that in a quarter under 3 years. So even though our managers were coming back, some of them in 18 months, we still maintained that time diversity in our portfolio, and that was really important. And it's something we push our managers on all the time, is that we want to see 3-year investment cycles for them.
I mean this nicely. You push your managers all the time. Are your managers not just come on, yep, I got a queue of people out the door, dude, next?
Yep.
I don't mean that rudely at all, but do you know what I mean? It's
I think they're more polite than that. But I think we recognize that we will give our opinion to our managers where we think there's something there that it makes sense for us to talk about. If they don't want to listen to it, then that's fine. Ultimately, they're the ones that are playing the game on the field, and as an investor, we trust them to do that. If they decide that ultimately they're seeing such great opportunities that they want to put their fund to work in 18 months, then they've earned that right to do that. But they've also must recognize that they will be held accountable for what they do. And it's not to say that we'll walk away from a manager if they have one bad fund. That's not the case. We look at these as long-term relationships. And so, if there is a bad fund, as part of that, we want the managers to be honest about, have they really thought about, what are the reasons for that? What are the lessons that they've learned? Now, they might just be saying that and will continue to do what they want. But ultimately, it comes down to if it's happening consistently, that's going to impact performance. And when it starts to impact performance consistently, that's one of the reasons why we'd walk away.
How do you think about fees and carry and sensitivity around those? We've seen some of the best firms and some of the names I'm sure that are consistently in the top 1% of companies even have 3 and 30. What a brilliant business.
I've never seen a 3 and 30.
You've never seen a 3 and 30? Oh, really?
No.
Okay. What have you seen that's the highest?
2.5. I'd have to double check that, but I'm pretty sure there's nothing that I've seen that's a 3 and 30.
How do you feel about fee and carry increases to the 2.5, to the 25, to the kickers? How do you feel about that?
For us, it's about net performance. So, what does that performance look like after the fees and carry have been taken off? And if it's consistently top quartile and it's consistently strong, then we're relaxed about that. I think I would prefer to see the carry be tiered. So I've got no issues about paying for performance. But I think it's important, ideally I'd like to have that alignment of interest so that if you have a great manager that has a poor performing fund, then that's reflected in the economics that go back to them for that specific fund. As you said, there's a whole line of LPs queuing out the door wanting to get into these managers, so that's, realistically that's not going to happen. So I think ultimately for us it comes back to what's the net performance.
Okay. What other things would piss you off? If there's deployment timelines compressing, fees and carry being elevated, anything else we're like, that's a bugbear?
We've talked about fund sizes. That is something that we continue to look at and to monitor. And I think it's important that we see. We still feel comfortable that whatever the fund size they're investing out of, that there's an opportunity for them to return the fund with a single investment. It's slightly certainly for early stage funds. I think for later stage funds, we probably want to see half the fund come back or the potential to return half the fund from a single.
Can I ask, what's your distribution of dollars across the stack, across early kind of MBC and then
so we kind of for us, so we've got 1 or 2 managers that would have seed funds, but there's probably 3 or 4 seed funds that we're invested in across our managers. The majority of them would be early stage, and that would be kind of A and early Bs, and then I think virtually all of them would have some kind of fund to do later stage deals, whether that's a fully fledged growth fund or whether it's more of a kind of continuation fund, a sort of opportunity fund, a select fund, that sort of thing. It varies. We want to be sort of roughly 50-50 between early and growth. It's a challenge to manage that. If we end up being sort of 45-55, I think we're comfortable with that. We don't want to be 30-70.
How do you feel about the stapling? Because it's hard, in the best managers especially, they have IR teams. I'm intrigued to see how you feel about those. But they also say, great, but you need to do India, you need to do growth, you need to do X. And it's like, oh, Christ, I just wanted to do your early stage fund.
So we go back to the data and we look at the performance. And so, whichever way we cut it, it's really interesting. So we looked at what's the performance of the early stage US funds from our core managers from 2005 onwards. What's the performance of the growth funds from our core managers from 2005 onwards? What's the performance of the non-US funds from 2005 onwards from our core managers? It's all the same.
It's all the same?
It's all the same. In aggregate, it's all the same. It's a 0.1, 0.2 TVPI difference. It's all the same.
DPI difference or not?
The growth funds come back quicker with, the distributions come back earlier in the growth funds.
Wow.
So
why don't you do more growth?
Because we think the growth is probably more economically sensitive. So it's more, if you think about what goes into the driver of a great growth investment, entry valuation is probably disproportionately more important than it is on the early stage. And also the size of exit is as well. So I think we've gone through a period where we've had some very strong performing growth funds, and if I showed you a list of the TVPI of all our core manager funds, you would not be able to predict which was a growth fund and which was an early stage fund. Our best performing core manager fund in the last 15 years is a growth fund. So, I think it's really interesting there. But I think we feel comfortable that the best managers have that ability to pick the best companies. And as companies are staying private for longer now, it does feel that there's more of an opportunity to generate venture type returns from slightly later stage investments.
Roger Ehrenberg said on the show, venture returns will get worse. Do you agree?
For existing funds or for new funds?
Both. Take one by one. For existing?
For existing. So I think there's no question in my mind that there's still more pain to be had for existing funds. I look at the carrying valuations that we see for a lot of companies, and they vary quite wildly. Some of our managers have been pretty aggressive in writing things down, others less so. And on the times, one of the things we are interested in is when we do get pitched from newer managers, one of the things we look at are where are they holding their marks. Yeah. And generally we've seen the new managers holding last round value marks and not writing anything down, where it's the more established managers that are perhaps earlier in that cycle, they're ahead of the curve in writing stuff down. So I do think we're only part of the way through that. One of the other things we track is loss ratios. So what percent of companies backed by our managers are below 1x? Yeah. Historically, for an early stage fund, that's been 60% of companies don't return 1x cost. We've seen that reduce significantly for more recent vintages. My sense is that it's going to go back to the average. It's going to go back to that sort of 60%. So I think there's a lot of pain still to be had. So that's not just companies who are going to get see their values reduce. I think there's a lot that ultimately aren't going to be successful and go out of business. And we haven't really had the wave of that happen yet. It feels like that's still to come. I don't know. I'd be interested in your perspective as a VC as well. How are you seeing that?
Well, I mean, I think the thing that we see from the data that we have, which is a lot, is the chasm in values that different people have in their books. And just extraordinary chasms in value. I was looking at one today, and one was valued at 800 million, and the other person had it at 10.2 billion. That's a fair wedge of difference between the two. And so I feel for LPs, because I think it's really difficult to get a fair grasp of what is the true value of your underlying book. And I think that's very hard. So, and I definitely agree with you. The managers who don't need to posture and present a brilliant facade don't need to.
Yeah.
And so I think you get a lot more truth to that. I'm intrigued, when we think about that. Doug Leone said before, we've seen the transition from a boutique high margin industry to a commoditized low margin industry. Do you agree with your 32 years of experience?
I'm not going to argue with Doug.
But really?
I do. I think what has happened to the venture industry, when I started, venture was kind of, there was, a bit of semiconductors and hardware and a bit of software on the West Coast. There was a, bit of hardware on the East Coast and some biotech, and it was a pretty small cottage industry. I think what you've seen is over the last 30 years, the venture industry has expanded significantly. There's almost multiple parts to that industry now. So I would say it depends on which part you're talking about. If you're talking about, the people that are raising multiple billions of dollars to do, to do the crossover deals, the late stage private rounds, then I think that is more of a capital allocation exercise than it is a kind of craft business. So I think returns there will probably come down because the weight of capital will make entry values become efficient, and I think we've seen that in a lot of other areas as well. So parts of the market, I think that is true, but I also think there are other parts of the market where that's less true, because it isn't necessarily about, is capital a strategic advantage? In certain parts of the industry, I think it's still a case that too much capital can be detrimental to a company. So I think there's parts of the industry where you will see that craft approach, and for me, it's still around it's still around the kind of, the seed stage, the Series A, maybe the early Bs before things are really driven by the underlying metrics of the business. And it's more about an understanding of market potential and taking a view on founders. I think the more quantitative the decision becomes, the more that excess returns will probably get competed away.
Can I ask you final one? When you think about your biggest mistake, a fund that you regret doing, when you review, don't say it obviously, I know you won't, but when you review that decision, what did you not see that was the determinant of that fate?
I think one of the challenges with investing in venture is that there are so many unknown unknowns, and the degree of randomness that leads to that is involved as to whether something is successful or not is high, and the earlier you get, the greater that degree is. So I think there are certainly things that we couldn't have been expected to predict at the time we were doing the deal. And one of the things we do with our investments is sort of 4 or 5 years post investment, we'll do a decision review analysis of those, to see what can we learn from that and how can we improve our decision. One of the big things that we learned was we used to only take references on managers from VCs that they had invested alongside. So we wanted to know what were they like as a partner, what were they like on the board. What we didn't do was, if somebody was operating in a particular space and we knew one of our managers was one of the top investors there and they hadn't done any deals with that manager, we just didn't follow up on that. But now we'll actually say, we'll phone that manager up and say, like, why haven't you done any deals with this group? Like, what is it, just that you're in different parts of the market, or are there specific reasons for not having done those deals? And I think sometimes we learn interesting things from that. So I think that's probably the biggest thing that's come out of our decision review process, is not just to reference people who we know work with each other, but reference people who are in that particular sector and who we would normally expect to have worked with.
Do you not worry that that's just competitor shit talk? Do you know what I mean? Which is like, you ask someone, oh, what's it like with X? And they're going to be a competitor in a lot of cases. Well, that's shit, and the partnership's breaking down, and they have a broken decision-making process, and the brand's there. But do you not worry that you're actually letting imperfect information then impact your decision-making process?
Yeah, I think the importance there is you have to triangulate. So there's not just one specific source of information that is primary. I mean, there's stuff that and you also have to understand, you have to have that relationship with your VCs that are they the sort of person that craps on everyone? Are they the sort of person that gives everyone a great reference? And you need to sort of have that history with them where you can put that into context, what they're saying. And I think that's really important. And that just comes from time and building those relationships and having those conversations. And it's getting harder. Particularly where, you mentioned firms that have, big IR departments, and it's harder to have that interaction with individual partners. You've got to work at it more.
Yeah, it's tough. I want to do a quick fire with you because I could talk to you all day. So I'm going to say a short statement. You're going to give me some immediate thoughts. Does that sound okay?
Yeah, go for it.
What have you changed your mind on most in the last 12 months?
So if you had spoken to me, maybe not quite the last 12 months, but certainly sort of 2 or 3 years ago, I think we were incredibly skeptical about LPs doing co-investments, direct co-investments, because we looked at the data, which is, we know 60% of deals don't return capital. And we just thought, why would LPs be doing this? What's the likelihood that they're going to be getting into those top 1% companies? I think my view has definitely evolved on that. I'm not all the way there yet to say that actually it's a good thing, but I do think there are situations in which there are different ways to optimize for those top 1% companies. One is to do it through the best primary managers. One is to do it through secondaries. And I also think another way selectively is to do it through directs. But directs in established companies, not with seed stage managers.
What would you most like to change about the world of venture?
I think venture is certainly venture at the highest level is quite exclusive, and so I think I'd like to try and democratize venture to some extent, and that works on multiple levels. So it's about giving everyday investors the opportunity to invest in a Sequoia or an Accel or an Andreessen or a Kleiner Perkins or an index, and not just Ivy League endowments, because I think, for the average person, it's tough, and venture done well, can really drive significant outperformance over a long period of time. So I think giving individuals access to that, I think, would be great. But I also think from a, looking at who comes into venture as well. I mentioned, no one in the village I grew up had ever heard of venture. I was lucky; someone was willing to gamble on me.
I mean, I don't think anyone had heard of venture in Britain in 32 years ago. I mean, seriously. I mean, it was like,
yeah.
I mean, this was, yeah.
Yeah, but I also I think about, who's growing up in that village today and what's their chances of being able to, create a career in venture. It's really hard. So, trying to open up venture to people, you need to be an exceptional person in order to do this well as a GP. But I do think I would like to see the sourcing of GPs broaden. I think it's a challenge. We had the conversation.
Dude, I mean, it's nicely. Are you not like centered to this? Like, you're the most exclusive of exclusive LP. Like, you add no one. You don't. I mean, it's nice that you don't take a chance on anyone, in the nicest of ways. Like, and I mean, like, I know you do at the intersection of Fund 3, but to get to Fund 3, Jesus, you've got to pass through the most golden, hallowed halls of endowment funds to get there. And so, I'm so sorry to just put,
no.
But it's like, but then be the change.
Yeah. So what we can't afford to do, though, is to gamble the money that our investors entrust us with. We have a very specific strategy that we think is able to generate consistently, strong and consistent performance across the cycle. I think the role of, one of the things we do want to try and encourage is to get people into the venture ecosystem from a diversity of different backgrounds. So one of the things we do as a firm is we signed up to a charity called GAIN, which is Girls Are Investors. So we take a placement student for 6 weeks in the summer to give them exposure to that. We run a 12-month placement scheme for university students, and we've done that for 6 years. And so far, everyone that we've taken on board has been a female student. I look at some of the things that some of our managers are doing in terms of trying to encourage diverse founders, and things are happening there, but it's tough, and I totally take your point.
And I understand your position too. By the way, which manager are you not in that you would love to be in?
Did Alfie ask you to ask this one?
Go ahead. I don't throw friends under buses.
So, I mean, I guess the one man, and it really hits close to home. This is I have a huge amount of respect for the folks at Benchmark and what they've done, and it's a really painful one. So, back in the day, we were investors with both Merrill Pickard and TVI, who were the precursor firms to Benchmark. And I remember having a conversation with Bruce Dunleavy, and he said, "We're spinning out, we're forming this firm, and we said, "Great, we love you guys, we'd love to invest." And he went, "Fantastic, it's $5 million. At the time, so this was mid-90s, at the time, we were managing a portfolio for a UK pension fund. And they had the sign off on anything we did. So we went back to them and said, "We've got this great investment, $5 million, Benchmark, fantastic track record, from these established firms. We're really excited about it." They went, "Great, but we can only do 4. So we went back to Bruce and said, "We're in, but is it okay if we only do 4? And he went, "No, it's got to be 5. We've never invested in Benchmark."
Oh, no. Oh, God, that is painful.
Yeah.
Should UK pension funds and universities be doing more?
I think if you look at the performance that the best university endowments in the US have had from venture, then definitely the challenge is, will they end up doing the best managers, or will they get pushed to do local managers? And I think that's one of the challenges that we've seen, particularly in the UK, when the government gets involved. Yeah. They want to try and encourage the UK venture scene, so they'll incentivize or restrict the ability of local investors to choose managers by performance.
Yep.
They'll choose them because they want to try and grow the UK venture scene, and for us that's really dangerous. It hasn't worked.
10 years time, you'll be 42 years. Where do you want to be then? Do you still want to be doing this?
I mean, the first thing is I just like to be around generally.
You're not that old.
I'm not taking anything for granted.
You're like 54, no?
Yeah, 54.
Yeah, you look great.
Well, thank
You'll
you.
be 64. You're fit. You're fine.
Yeah, you never know. So, but I think, going back to what we were talking about around succession, for me, it's really important that we've got some really good people in our team, and it's super important that they have a pathway to grow and become the next leaders of the firm. And I don't want to get in their way. Now, at the same time, I love what I'm doing, and so if they feel it would be useful for me to hang around in some capacity, I'd love to hang around and support them. But I think it's really important that they're the ones in 10 years' time that are driving the company, driving the strategy, driving the future of Vencap. And if I can be helpful to them, I'd love to be helpful to them.
Listen, I've loved this. The best ones for me are real discussions. It's not a script, it's a discussion. This has been fantastic, and thank you for being such a great guest.
Thank you. And I've really enjoyed the fact that we don't necessarily agree on everything. And
anything.
That's what makes a market. If everyone agreed on everything, life would be so dull.
Honestly, I love doing that. Thank you so much. You're fantastic.
Thanks a lot, Harry.